Swing trading is a popular strategy where investors aim to capture price moves over a period of days or weeks. Let us break it down. The goal is not to catch the exact bottom or top, but to profit from the middle portion of a price swing. Unlike day traders who close positions before the market bell, swing traders typically hold their assets for several days or even weeks. Swing traders rely heavily on technical analysis to spot patterns, using tools like moving averages and support levels to guide their entry and exit points. Day trading requires intense focus throughout the session, whereas swing trading offers a bit more flexibility since positions are held overnight. Swing traders often look for higher volatility, as price movement is the primary engine for potential returns in this strategy. Because swing trading involves holding through the overnight session, protecting against sudden price gaps with stop-loss orders is a critical rule of thumb. Swing trading involves significant risk of loss. Always do your own research before committing capital. Thanks for watching and subscribe for more basics.